Good evening, everybody. Midstream is ended. Never fear, the milkman is still here. So I see that Nick's Hobbies channel created the funniest picture of Steve in traffic. I don't know how you share it, but I would like to see it because I am sure that would be hilarious after everything you guys have heard of me being in traffic. Yep, I am no longer in traffic. I am in my home office. Wild day today. Couple of rants for tonight. I want to go through the Netflix and Warner Brothers Discovery deal. This is I've been saying for a long time that this company needs to get acquired. I've put it in my articles probably at least starting a year ago or a year and a half ago. My original thesis was Apple should have acquired them, taken all the assets and putting it right on Apple TV just to bolster their offerings against everybody else. They didn't do it. I said that there's only limited amount of resources in this area and consolidation is going to squeeze other people. Obviously, other companies being Paramount and Netflix thought the same way. And now we have a pretty big deal. So, breaking down this deal, the way that the Netflix deal is structured is valuing this at an enterprise value of $82.7 billion and equity value of $72 billion in a cash and all stock deal. So the cash and stock transaction would be $23.25 in cash, $4.50 in Netflix stock per common share of Warner Brothers Discovery. Deal closes after Warner Brothers Discovery spins off its global networks division, Discovery Global, into a separate public company, expected Q3 2026. This entire Netflix Warner Brothers deal is not expected to close for 12 to 18 months from now, subject to Warner Brothers Discovery shareholder vote and regulatory approvals. So Warner Brothers on its own is expected to do $3 billion in EBITDA in 2026. Netflix is targeting $2 to $3 billion in annualized cost savings by year 3 post-closed. Let's see. With an assumed $2.5 billion run rate in their base case, pro forma Warner Brothers EBITDA to $5.5 billion. Let's see what else. A lot of savings on the corporate and support functions, overlapping tech stacks and infrastructure. Look, I think that this is a good deal for Netflix. Here's why I like the deal for Netflix. And I don't think it's going to go through. I'm going to give you my reasons why. So let's get comfortable for this rant. So Netflix is an incredible company, but it is the number one streaming service. I mean, let me see if I can get a list of all the top streaming services with the amount of people using it. So just a quick AI overview from Gemini, or through Google, through Gemini. I'm going to share the screen. Assuming that this is correct. Now, once again, not my numbers. This is just a list that Gemini put together. Netflix has around 300 million subscribers. Amazon Prime Video, over 200 million, which is bundled with Prime. So you got to take that with a grain of salt because a lot of people that have Prime may or may not use the service. Disney Plus, around 125 million. Then HBO Discovery through Max is, call it 115 million. Paramount, 72 million on the high side. Hulu, 55 million. Peacock, 41. Apple TV, 25 to 45 million. Exactly why Apple TV should have taken out Max. They're obviously not. I'm an Apple shareholder, so I'm trying to be nice about it, but they're just not serious about the content game. They're not. I'm sorry. They're not. They would have made an all-cash deal, not let Netflix do a single thing about this, and taken this piece off the table. They're not serious about content. That's why they're the least compelling streaming service out there. The reason I don't think that this is going to end up going through, and look, we knew Elizabeth Warren was going to come out, but Senator Warren makes a very good point that, quote, a Netflix Warner Brothers would create one massive media giant with control of close to half of the streaming market, Warren wrote in a post on X on Friday. It would force you into higher prices, fewer choices over what and how you watch. I actually want to look at the entire post. I'm going to read it word for word. Give me a sec. All right. We're going to share her post. Oh, you know what? I just screwed up. I'm going to have to read it because I want to keep this up. So I'll read it word for word. Senator Warren, news, Netflix is trying to buy Warner Brothers. This deal looks like an anti-monopoly nightmare. Oh, anti-monopoly. Anti means, well, I think that's kind of an oxymoron there, but whatever. A Netflix Warner Brothers would create one massive media giant with control of close to half the streaming market. It would force you into higher prices, fewer choices over what and how you watch, and may put American workers at risk. Under Donald Trump, the antitrust review process has also become a cesspool of political favoritism and corruption. The Justice Department must enforce our nation's anti-monopoly laws fairly and transparently, not use the Warner Brothers deal review to invite influence peddling and bribery. So when I look at the numbers, and it's simple math, if we say Netflix does 300 and Max does 110, that's 410 million between the two platforms. That's more than Amazon, Disney, and Paramount, right around the same as the next three. It's not half of all of streaming, but keep in mind what's not on here. YouTube. We don't know how big YouTube is. I don't think that they're going to be able to get this on an antitrust. I really don't. I don't think they're going to be able to get this on antitrust. But I do think Paramount, looking at the numbers, and Max combined will pass regulators much more easier than Netflix and Max. Now, Netflix has all the reasons in the world to do this. These are assets that are never going to come up again. And I do not think that we are done with this story. I think that we are in a position where Larry Ellison is going to go back to the drawing board, and they're going to offer the $5.8 billion, maybe more, on the breakup fee, and go directly to Warner Brothers shareholders and try to offer them a better deal. Because he knows once Netflix gets their hands on not just HBO and HBO Max, but Warner Brothers Studio and all the content on it, those are assets that never hit the market again. And then what's Paramount going to do? Try to acquire Peacock? I mean, this is HBO Max and Warner Brothers are two crown jewels. You also have DC Comics in there. This is not going to go down without a fight. And for Netflix, they gain so much content. If I was Netflix, I would kill HBO Max. I would embed everything into Netflix. I'd charge maybe $4 more a month or something like that. I'd have to play with the numbers. But the big thing is you gain Warner Brothers Studios for all of your TV and all of your movie sets. It would be absolutely amazing for Netflix. Now, Do I think the administration is going to let this through? I have no idea what the administration is going to do. But when I put on my tinfoil hat and I am going to make it, you know what? This weekend, I'm going to get a roll of tinfoil. I'm going to make a tinfoil hat and keep it on my desk. And we're going to have tinfoil hat conspiracy corner. Because my tinfoil hat conspiracy at the moment is that Larry Ellison is going to go to the administration, plead his case, and throw an enticing aspect out there that if we spin things off, we're going to keep CNN and watch how fast CNN becomes pro this administration. I would not put that past him at all. I would not put that past his sons. And that is something that who knows if that even helps. But I do think at the end of the day, a Paramount Plus Max deal has less scrutiny than a Netflix HBO Max Discovery deal, because it's just, you're not the number one, you're not even bigger than Amazon combining Max and freaking Paramount. So I don't know. I don't think that this deal is going to get done. I want to see what some people on CNBC had to say. There's a lot of commentary about this. There's also big implications for traditional TV. So there's a lot. I do everything real quick. So there's some people that think trimming Netflix is a mistake here. Regulatory stuff. So just give me a sec. This is interesting. That's going to ultimately destroy Hollywood. Okay. All right. Here's a good one, or at least one that I think is going to be a good one. I want to react to a few of these.
Winning the bid to acquire WarnerBros. Our next guest arguing against the deal, saying it poses an unprecedented threat to the industry, adding that theaters will close, communities will suffer, and jobs will be lost. Let's bring in Cinema United CEO Michael O'Leary for more. It's great to have you with your reaction here, Michael. So what are you guys going to do about it? Are you going to file a complaint with the regulators?
Certainly, we're going to thank you, first of all, for having me this morning. This is a very important issue for our industry. And we're going to be pulling all of the levers we can, because we think that a deal of this magnitude, with the potential impact it will have, is something that everyone with regulatory and oversight authority needs to look closely at. So we've already been talking to people at the federal level, at the state level.
I mean, in all seriousness, how many people go to the movies anymore? I will put a poll out. Let's keep watching this. But in all seriousness, do we just all wait? And I've had this view for a while that many people have a mini movie theater in their living rooms or in their bedrooms at this point. TVs, you can get a really good 75 or 85-inch TV for under $1,500. In some cases, under $1,000. You can go get a soundbar and speakers for not that much more. I mean, it's crazy to think that people still go to the movies the way that they used to.
And internationally, because this is a significant threat, we believe, to the long-term viability of theatrical exhibition.
Why? Is it your expectation that once Netflix does this, that we won't see theatrical releases anymore? We won't see the box office anymore? They'll just release it on their streaming platform?
I think if you look historically, when legacy studios are absorbed by other entities, even in the case where those other entities are also legacy studios, the amount of movies produced for theatrical distribution goes down. In this case, it's particularly problematic because the party acquiring Warner Brothers in this case has, that's not what they do. They focus on television, and they have been consistent in saying that they're not interested in theatrical exhibition. So if you're looking at it from the perspective of exhibition, just a few short years ago, 20th Century Fox went away, resulting in a 46% decrease in the number of titles that were coming out of that studio. You layer on top of that the potential that the Warner Brothers catalog will no longer be available in a meaningful way to theaters, and it's just impossible for the industry to absorb that kind of loss in such a short time.
Meanwhile,
I don't think he's wrong. The problem is I don't think anybody cares about the movie theaters anymore. I mean, I'm going to look at the chat real quick. Just start putting in. We'll get to the S&P 500 inclusion in a little bit, everyone. Seriously, do you guys go to the movies? Let me bring up my channel. I can't do a poll from StreamYard. Give me a moment. Let me bring up my channel. I'm going to put the poll in, but I am reading the chat. I mean, I can't think. The last time I went to the movies was take my nephew. Like, I don't go to the movies. All right. Poll. Start a poll. Do you still, well, how about this? Do you go to the movies more than 3 times per year? All right, please answer this. We have over 500 people here. Please answer this. Do you go to the movies more than 3 times a year? I am so interested in this. And other than taking my nephew, the only time I would go to a movie at this point in my life is if there was something that I wanted to see in IMAX. And here's the other thing. I really wanted to see F1 in IMAX, and I was saying I want to see it in IMAX, and I never freaking went. Like, I never went. All right, so we have 156 votes already. 73% no. I just think, and I've had this view for a while, home entertainment has gotten so good and the streaming services have gotten so good that a lot of people just don't go to the movies the way that they used to. It's no longer a big thing. I mean, this was big in the 80s and 90s and even the early 2000s. Movie theaters are not big anymore. I'm more and more convinced. 185 votes, 75% no, for more than 3 times a year. Mood food date night with wife maybe once a year. Is IMAX still? Yeah, IMAX I think is still a thing. I mean, I'll agree the pandemic killed movies. I will agree with that. All right, we'll end the poll. We have over 200 votes. I mean, so now keep in mind, I put, do you go to the movies more than 3 times per year? I'm going to do one more poll, and I'm going to do once a year. Let's see how many people go to the movies once a year. Do you go to the movies at least once per year? Start poll. And keep in mind, I love IMAX movies, okay? I love that. The first time I went to an IMAX movie, I drove 45 minutes, which is a lot for me, given where I live, to go see 300 in IMAX. It was insane. I went and saw one of the Bond movies. It wasn't Casino Royale. I think it was Quantum of Solace. No, it wasn't Quantum. I don't remember which one it was. I think it was the one that Batista was in IMAX. But other than that, I haven't. All right, so do you go at least once a year is 50-50 right now. All right, yes, pulling ahead. We're going to leave this up for a little bit. We're going to get another view on this. Looking for the Sorkin video. Here we go. All right. Let's see what the guys say.
It's winning the bidding war for Warner Brothers Discovery this morning, a huge transaction worth $72 billion.
The combination of Netflix and Warner Brothers creates a better Netflix for the long term. It sets us up for success for decades to come.
I think Netflix is buying Warner's for the stock value. They've got that. They're the growth stock. What they need is to grow subscribers and to grow the overall audience. And they see the intellectual property and the library that Warner's offers as being pretty important. This is going to be a very difficult regulatory process for this transaction. The industry is not excited about this. I mean, my DMs and texts blew up last night with some pretty dour messages, because anytime you take out a buyer in the entertainment ecosystem, it results in fewer opportunities. Now, Netflix would argue that they're going to be stronger and they're going to grow more and they're going to have more opportunities for talent to work on bigger and better projects. But the history of the business has shown that when you take out a buyer, you reduce opportunities.
If you think about Netflix, the engagement has stagnated a bit, and I think one of big investors' biggest concerns has been, why is engagement not growing faster? This is sort of an acknowledgement that Netflix is looking at this going, there is so much underexploited IP in this company. And I think they're looking at this as, how do they use Warner Brothers to re-accelerate the overall engagement growth and time spent? There is just so much stuff. I really believe this is all about the IP, and Netflix is looking at this as, how do we take this library and make 1 + 1 equal way more than 2? This is going to be great for consumers. I mean, there's no doubt about it. You're going to get a lot more content at low pricing. Like, that is clearly going to be the messaging, I guarantee, from Netflix. Lots of content, shorter movie windows. Like, this is going to be very consumer friendly. Obviously, Hollywood's going to have to kind of get their minds around it.
I think when you
So I do agree with what he said from the aspect of, when you think about movies leaving the Netflix ecosystem, the entire Warner Brothers network and library is going to be on indefinitely, most likely, as long as they merge everything on there. So this could be very good, even if you have to pay a little bit more. This should be very good for Netflix and for the consumer from that aspect. I still don't think it's going to get done, but I do agree with him.
you have Netflix, which is the largest streaming company, acquire this kind of power in an $83 billion deal, they're paying that price for a reason. When you're looking at a deal like this, you're thinking about, how does this affect the producers? How does this affect creatives? How does this affect actors, distributors, content creators, content funders? I can't overstate the fact that as state enforcers, certainly in addition to the federal government that are going to be looking at this deal, they are looking at the fact that when this deal closes, if there is an impact on the number of stories that get told and the types of people that get to tell those stories, that is a harm to our market, and that is a harm to the economy and to the American people that should be credited.
So that's an interesting point that I didn't think of. I'm not a lawyer, so I will not be able to answer this question. At the same time, what I'm thinking is, how many state regulators are going to have to sign on to this? And is California and New York going to have to sign on to this? I do not know that answer. I will start looking into it. But they could have, if this is not just a federal thing, that they need state regulators to get on board, there could be a big problem with this.
We've already been talking to people at the federal.
We saw that in the last interview. Let's skip him.
Very risky bet for Netflix, and even riskier bet for Warner. When you're a seller, the only thing that matters more than price is certainty of closing. And when you have this kind of regulatory risk across so many different dimensions, federal, state, in terms of domestic, but also international, on top of all the filings that are going to take a long time, there's a tremendous risk that Warner won't close the deal.
All right. Give me one sec. Yeah, I mean, so let's go back to cinema real quick. I'm ending this poll. So 238 votes, 51% go to the movies at least once a year, 49% no. And then when we do 3 times a year, it becomes around 75% no. So movies are certainly not what they once were. So I don't know that we can really make the comparison on that. But I do think there's going to be a lot said about Larry Ellison not going to go down without a fight. He didn't build Oracle without getting his hands dirty and having to freaking go head-to-head with people. I think they're going to go directly to shareholders. This is not a done deal. And I do think that they're going to sweeten the pot. And quite honestly, even if they overpay, and even if they have to come over the top, this is something that is worth it, in my opinion, because these are assets that are never coming back up ever again. So I'd be surprised if Amazon or Apple doesn't try to get in on this. I'm very surprised that they let Netflix, and look, we don't know what players entered bids and what the bids were and all that stuff. I'm just really shocked that Amazon and Apple did not get involved in this. It is very surprising to me. We'll see. I'll tell you what, I'm sitting out of this. I'm not playing Netflix right now. I own Warner Brothers Discovery, not a lot of it. I got in the AT&T spin out, which has worked out pretty well. And we'll see. I mean, look, this was a stock that wasn't doing anything, has a ton of debt, over $30 billion in debt, does about $7.5 billion in EBITDA. It's a leveraged company, but they got trophy assets. Look, I am just shocked that this looks like it's going down. We'll see. I don't know. Let's see. Netflix with Warner Brothers, they can go toe-to-toe with Disney's DC versus Marvel Star Wars. Yeah, I mean, look, Netflix will own DC. DC is part of Warner Brothers Discovery. Netflix has a lot to gain here. A lot to gain. So I think it's a great deal from them. Now, the question is, are they going to let it go through? Does the administration have an axe to grind with the Netflix top brass? And are they ultimately going to allow this through? I really think that if Paramount goes to the shareholders and makes them an enticing offer, I think they can say, hey, wink, wink, nudge, nudge, this is going to get done. We have the inside track. This isn't going to be a 12 or 18-month thing. This is going to be more like a 6-month thing. And I just think the regulators are going to give it an easier time because at the end of the day, it would be the number 5 and number 6 companies. Number 5 and number 4 companies combining, not number 1 and number 4. This is just, it's really crazy to think that this is where we are. I always said there's been consolidation in the space. I'm just surprised that, Netflix is the one that it wasn't freaking, and I keep saying Applebee's their cash pile, and they're afraid to use the cash for anything but buybacks. And it's annoying. It just shows they're really not serious about content at all. Next year, Netflix buys Disney. I got to tell you, I don't like Disney. I think that Mickey Mouse and that whole era is going to be freaking goners. If you buy Disney, you spin out the parks and everything else. So let's see. I want to see what Josh Brown has to say. Look, I think everybody knows Josh Brown's one of my favorite analysts on CNBC. He is a very straight shooter. Top 3, him, Stephanie Link. And I like all of them. Stephanie Link and Josh Brown, my 2 favorite, then Joe Terranova, then Farmer Jim. So let's see what he has to say, and then we'll transition to my SoFi rant.
I still do, but I can't sit for a year and watch this become a political football and tie up capital. So it's just a portfolio management decision. I think there are going to be other opportunities that have more near-term upside while this Netflix thing works its way through the meat grinder in Washington. I want everyone to understand, I think Netflix right now represents a tremendous value, but I don't think the stock will be able to get out of its own way. The thing to keep in mind here is we don't know if an over-the-top bid comes. We don't know what Republicans are going to want to talk about as it pertains to this. We don't know what the Democrats will want to talk about. There's a lot of antitrust.
Like I said, I really think that this is going to have a hard time getting through. I have that feeling.
There's a big antitrust contingent in both parties for different reasons. Then, of course, there's the White House. This would be the second largest merger or acquisition in the post-pandemic period worldwide, other than Norfolk Southern and Union Pacific, the railroad tie-up, at $85 billion. You cannot tell me the Eye of Sauron is not going to see this thing happening and say, what does this mean for us?
You know what? If Amit was here, I would ask him what movie quote did Josh Brown just use? Everybody, let me see it in the chat. What movie quote did Josh Brown just use? Come on, somebody's got to know this. Thank you. We got, all right, people know it. Thank you. Thank the good Lord. Thank the good Lord. He's never seen those movies, by the way. So I will never make fun of him about steak again. His new nickname is medium rare because he ate some stuff that was still moving the other night and he actually truly enjoyed it. I don't think he's ever going to order a steak medium well again. Maybe he'll order medium, but his new nickname is medium rare. And I will still make fun of him about movies because there's no way he saw Lord of the Rings. And the fact that Palantir's name came from Lord of the Rings, he really should watch them.
And keep in mind, this is media, so it probably means something. I'm not telling you they have to put The Apprentice back on the air or it's going to be something like that, but don't be surprised if this takes over a year, produced by Barron. This could take over a year. So look,
Celebrity Apprentice. That's going to be the remedy.
Yeah. Right. I have tons of MAGA Apprentice. So all I'm saying is I think Netflix is a great value. I think it's a great deal. I actually love the deal for them. Not only for them, but I love that they're keeping this out of the hands of somebody else. Equally important in the streaming wars. But
I mean, that's been my thesis. Consolidation, take assets off the table, keep it out of the hands of your competitors. That's been my thesis. For those of you that follow me on Seeking Alpha, that's been my thesis. And I've been saying Apple should buy them. I got to tell you, Josh Brown and I, we're on the same page about a lot of stuff. What he was talking about the other morning, it's almost like he caught the stream the night before and was regurgitating everything I said about what are you going to do? You're going to try to say Costco's better buy than NVIDIA at 45 times? He sounds like the milkman. I think we need to get a Josh Brown milkman stream.
But I can't sit here. So I kept a very small position on, and we'll see what happens. We'll watch it for the next 12 to 18 months and see how this goes.
I thought some of the, Kev, you have the stock too. I thought some of the notes from the street today about the strategic nature of the deal and how it's a departure for Netflix from how it has historically done things. Huber Research says we've had an overweight for nearly the entire time over the last 10 years, but are stepping aside. Netflix has been very successful the last 15 plus years developing its own content and has smartly stayed away from doing sizable deals. We do not see the need to change that. Baird weighs in today. Certainly a deviation from the company's historical approach, and we understand the initial investor hesitation regarding the size of this deal and the potential closing integration process, but we suspect the long-term benefits will ultimately outweigh the near-term risks. You as a shareholder have to be willing to sit for the long haul. You have to have a bigger vision, but the notion that this is historically different than what Netflix is used to doing, not unlike you might hear if Apple was to make an acquisition of some scale larger than it's ever done before, you'd probably have similar notes.
Yeah, I hope we do see that from Apple, Scott, and I'm thrilled to see it from Netflix. I'm going to take the other side of this. I think it's incredibly wonderful to see them go on the offensive. This is an IP play that if the deal were to go through, and I agree with all the notes and Josh's comments that the likelihood is pretty thin. I also think that we'll see a competitive bid from Paramount Skyworks to, a hostile bid from them to keep this deal alive. But if it did happen, you kind of think of it like the Disney deal when they bought Star Wars and when they bought Marvel. When you're talking about some of these franchises, Game of Thrones, The Sopranos, the DC Universe, Harry Potter, what Netflix can do
Sex
with
in
this.
the City.
I never saw it. I think it's an amazing opportunity.
In all seriousness, Sex in the City was a huge show. Nobody should discount that from the library. Huge show. I think the movies were even big. Game of Thrones, Sopranos, Oz, The Wire, Entourage, Deadwood. I mean, HBO arguably has the best TV programming. They really do. I mean, they have unbelievable programming. They're right. Apple should have went on the offensive. once again, Tim Cook sleeping on the job as an Apple shareholder. I want him replaced.
For this company to just take these franchises into a whole nother stratosphere. So I'm excited about the deal, and I'm happy.
What do you make of Josh's move to sell 85% of his stock?
I think it's a mistake. I think I would be more of a buyer of the stock. If the deal does get blown up, the stock will go higher. And plus, the one difference between Josh and I is I can write covered calls against this. There's going to be heightened volatility now around this name, even more so.
Well, but that's why he's bowing out in such a large way. He would agree with everything that you've said, I'm sure, on the fundamental basis of this.
Yeah.
The stock itself, the company itself, the leadership likes all of it. But you're going to be in some level in what he suggests is purgatory for the next 18 to 24 months while this whole thing plays out. And then who knows how it ends.
You don't think it's in a box? You don't think it's stuck in a box now?
It may not be accretive to the bottom line, Josh, for 2 or 3 years. I don't disagree with that, but I don't think the stock's going to sit here and just level off. And if it does for me, which is different than for you, I can still write premium against it. So it's less of a concern for me for a range-bound stock. So I get what you're saying, but I would hate to be a seller at this point, only to look back and say, look what happened. Look how amazing this deal turned out to be.
I mean, I get what he's saying, that if it stays range-bound, he's just going to write cover calls like a lot of people in the chat. But I don't know how I feel about it. I would look, I can't say what I would do because I'm not a shareholder. So I'm certain this deal does not make me want to go buy Netflix. I can tell you that right now, because I do think if I had to predict what's going to happen, my prediction is that this is going to stay range bound for a while because there's going to be so much uncertainty if it actually gets done or not. And I think ultimately that's a pretty big problem. Does it get done? Who knows? I can't tell you. Does JRE go to Netflix? Well, JRE is locked up by Spotify for a while. So I don't know. Probably not. Yeah, some people think, or I guess some people are agreeing that this can be range bound. I mean, look, it can go up, but there's just a lot of uncertainty because think about this. What happens if this falls through and it doesn't work? What happens to Netflix stock? Because then you're going to get a narrative of they bet the farm on this deal going through. And if the deal doesn't go through, they're going to have to pay Warner Brothers Discovery $5.8 billion, and then they don't get their cake. So not only are they out $5.8 billion, they're not getting their cake. I got to tell you, it's risky. This is risky for Netflix, in my opinion. Once again, I'm not a shareholder. So I don't know. I'm not even a subscriber. I get Netflix twice a year. I get it for a month and then exit. There are only 2 shows I care about on Netflix. They are The Recruit and Night Agent. So whenever the new seasons come back, I get it, and then I get off. There's nothing else I want to watch on it. So we'll see. Like I said, this is a great company, regardless of how I feel about the content. I don't know. It's going to take a long time. So let's transition. I've rambled enough about Netflix. No, I'm not a pirate. I will pay for the subscription for what I want to watch. I want these companies to make money, and I pay for the product. So, I mean, no, I'm not a pirate. So let's transition to the S&P 500. Good old SOFI getting snubbed. So let's see who got included. Let's bring up the list. S&P 500. How come when I type in S&P 500, the inclusion just happened? It just happened. You would think it'd be at the top of the search box, right? Are they serious? Well, we know SoFi didn't get in. We know Carvana got in, which I think is insane. Chenier was up. They didn't get in. Still trying to get the official list. I'm just going to go on X and type it in. Watch me get it right away on X. There we go. Good old Amit. First thing that, man, Amit really freaking is the dominant force in news media for stocks, isn't he? He's done such a great job. It's unbelievable. I typed it into Google. I couldn't get it. Typed it into Bing. Couldn't get it. Go on X. Typed it in. First thing that comes up is Amit. Guy's amazing. Carvana got in. Comfort Systems got in. CRH PLC got in. Removed. LKQ, Solstice, Mohawk Industries. No Reddit, no SoFi, no MicroStrategy. I do not want MicroStrategy in the S&P 500. Let's just be very clear. Don't want it. I think the fact that Carvana got in over SoFi is kind of crazy. I don't know much about Comfort Systems or CRH, so we can look at that. But I'm looking at Carvana's numbers right now. So let's see. UL Systems. Oh, that's the mid caps. Okay. There's nothing else in here that's that interesting to me. Pinterest. I mean, look, some people have a theory, not me, but just some people have a theory that eventually Meta is going to acquire Pinterest. I think that ship has sailed, but we'll see. So let's bring up Carvana's numbers, because for Chenier not to get in and Carvana to get in, I'm really, really surprised. I'm going to show you why. So look, I did not know that Carvana's growth was this much. I still think that this is a crazy idea that people are buying freaking cars out of a vending machine. Maybe I'm a boomer, even though I'm not that old and I'm not a boomer. Maybe I act like a boomer. I will tell everybody this. One of my coworkers, okay, consistently makes fun of me because I call restaurants to order food. You know what? I'm going to put a poll up. Do you call restaurants to order food, or do you use the app? So I'm just going to put, do you call a restaurant? Or how do you order food? All right. How do you order from a restaurant? App, phone call. Really, it's not letting me autocorrect? I'm the worst speller. Like, I am legitimately the worst speller in the world. Spell check has made me horrible at spelling. So the story behind this is I get called elderly because I will call an order instead of just going on Grubhub or one of those sites. And I would rather talk to somebody and order it. And it looks like the majority of you also use an app instead of phone call. I get called elderly by one of my coworkers because that is the route that I take. You're elderly. Well, thank you. I guess I am elderly. I can't believe this. 68%. Really, guys? All right, we're going to leave that. We're going to leave this poll up for a few minutes. So Carvana's revenue, $18.3 billion. I can't believe how much they've grown. I mean, they've really grown a lot year over year in the past 2 years. Now, gross profit, not great. I mean, that's really not great. Operating income, all right. I mean, look, they're profitable. Okay. They got a bunch of debt, paying interest on it. Net income, where are we? We just pass it. So they've been profitable the past 3 quarters. It looks like they turned the corner. But 629 million, I'm going to write that down so I don't forget when I show you Cheniere. Okay. I'm going to make this a little smaller. I want to go to the balance sheet real quick and look at the debt. So they got, all right, 2.6 billion on hand. They don't have as much. I thought they had more debt than that for some reason. I need to look at what they did. Did they do convertible equity or something like that? I really thought that they had a much different type of debt structure there. Maybe I'm wrong. Maybe Carvana is not as bad as I thought it was. Maybe whatever they did a couple of years ago with the debt conversion actually really worked, because I thought it had more debt on it. Regardless, we look at LNG. I mean, how Cheniere Energy did not get into the S&P is insane to me. This is a company that is doing $4 billion in net income versus 629 million. I don't understand how Cheniere did not get in. It doesn't make any sense to me. The fact that Carvana got in over Cheniere is insane. All right, you guys got 180 votes on here. We're gonna end the poll. I guess I am elderly. Elderly Steve. 36% use the phone, 64% use an app. Craziness. So CRH and Comfort Systems. I mean, I'm not shocked that SoFi didn't get in, everybody, but I do think they got snubbed. And I'm shocked that Marvell is not in the S&P either. Now, I want to see a list of S&P 500 companies. Let's actually look at these. Let's see by market cap. This does not have it by market cap. Let's see. This does, though. Beautiful. All right. This is going to be interesting. So Mohawk and Solstice is gone. We know that. Mosaic Company, LKQ is gone. Alexandria, I'm shocked Alexandria is still in there. Match Group, a little surprised. Federal Realty Trust is still in there. Interesting. I mean, after the news about Campbell's Company, that's like, really? Campbell's Company is still in there? Generac, what an interesting company that's only a $9 billion company. I need to do some work on Generac. Baxter, APA, AES, JM Schmucker. FactSet is in the S&P, really? Okay, come on now. Really? Look at the, all right. I'm going to stop sharing that. Look at this for a sec, everyone. I'll bring that back up. But look at this. I'm surprised. How is FactSet in the S&P and Cheniere isn't? I mean, look at this revenue. This not growing. It's been at $2 billion for 4 years. That's insane. That is insane. I mean, look at SoFi. Look at SoFi on the revenue growth. Bigger company by revenue with revenue growth, and they're only getting more profitable and expanding margins. Like, sometimes it makes you wonder why they're only doing 2 or 3 companies at a time. I mean, what is Dayforce? I've never even heard of Dayforce. What the hell is this? Day. I think a fun exercise would be to go through every free. You know what? I'm going to try to figure out how to write a program. Maybe I'll ask ChatGPT or Grok to do it and do a full analysis and pump it out into an Excel sheet and do the profitability and all the margins and stuff. I certainly don't want to sit there and do line by line, but maybe I can figure out a way to code it to get it done. Camden Property Trust is in the S&P. Really? I didn't realize there were this many REITs in here. Like, come on. 1.58 billion in revenue. Okay. Hasbro. I actually know a lot about Hasbro. I'm very shocked to see this. I mean, Hasbro's been losing money. How are they still in the S&P? Let me look at the quarterly real quick. I'm going to reshare my screen. Give me 1 sec. Look at this. I'm surprised to see Hasbro there. I wish there was a quicker way to scroll, share everything I'm looking at. But I mean, look at this. Last quarter, Hasbro did $233 million in profit. The quarter before that, they lost $855 million. They made $98 million in Q1. They lost $34 million in Q4 2024. The fact that Hasbro is in the S&P and SoFi isn't, or Cheniere isn't, is crazy. I don't know why that was muted. I'm sorry. I'm actually going to call Mitt. I want to see if he's around. I want to ask him if he's actually looked at all of these damn companies that are in the freaking S&P. Regency Centers? Really? I'm getting more shocked. You have a minute? I'm putting you on speaker. You're live.
Okay.
So I have Amit. Amit, have you gone through? I'm going through the actual list of the S&P companies, and I'm losing my shit on the companies that are actually in the S&P right now.
Yeah, there's definitely some that, I mean, are questionable, to say the least.
Did you know Hasbro is an S&P 500 component?
I did not know that.
No, I'm serious. Hasbro is an S&P 500 included company. Regency Centers is a S&P 500 company. Like, this company does $402 million in revenue. Oh, I'm sorry, I have it on quarterly. I apologize, everybody. They do $1.58 billion in revenue. Like, they're a REIT, host hotels and resorts. Like, I know this company. It's another REIT. Like, when did the S&P get this heavy in real estate?
Well, the thing is, I I mean, tech is still leading the majority of the returns, so I feel like that's why they want to balance it out. But it begs the question: why those names are
What are half these companies? Ball Corporation? What is Ball Corporation? Like, I know a lot of companies. I've never heard of Ball Corporation. Like, what is this? This is actually a big company. I have no idea what they do. 12 billion revenue company. I have no idea what they are.
I don't know what CRH was. I was like, what is that? When it came out, it's like, okay, CRH. Like literally, I didn't see that name not once throughout the day.
I mean, this is, I got to tell you, we need to do, this would take a long time. I'm going to see if I can write code to do this. But I think we should go through these companies and be like, what the hell is the S&P doing? And figure out what should be in there instead. Like, there's a bunch of companies on the lower tier. Like, I'm only at 430 right now. But if I go back down, I mean, there are legitimately companies like freaking Campbell's that does not make sense.
Yeah, Campbell should not be a top 5. This is why this is when Robinhood didn't get in for so long. I was like, there's no way you're telling me Robinhood is not a top 500 company in this country.
Like FactSet Research. This is the one I flipped out about. FDS is in the freaking S&P 500. They do 2.3 billion in revenue, and their revenue has barely grown. Over the past 3 years, it's grown from 2.08 to 2.3 billion. Like, what are we doing?
Yeah, also FactSet is just like, I mean, are they really one of the most important companies in this country? Like, no, they're not. Not at all.
Somehow they're an $11 billion company.
Yeah, I mean, they're a good company. I know about FactSet, and like the data they provide is important, but like when you're buying a piece of the S&P 500, you really need to be buying like some data aggregator. Like, there's so many names that I feel like philosophically, why are these in everyone's retirement accounts?
And this just goes to show you why the freaking Mag 7 have such a heavy weighting. Who the hell wants to put their money in these companies? Like, that's the other thing. If you're picking companies, is anybody investing in these companies?
No. Well, I mean, there's definitely people investing in them. It's just they're not.
You know what I mean.
Yeah, they're not the names that most people care about.
Like McCormick and Company. I mean, this is not, and you know that I always say this is not exciting. Like, I don't care if it's as exciting as other things. Like, I like the dividend, that type of thing. But like, come on, McCormick and Company. I don't understand half the stuff.
Yeah, I mean, there were some good rebalances this year so far. Like Enphase definitely deserves to get, but there's a lot more that needs to be rebalanced.
I would say
politics
so.
Too.
Like, okay, Church and Dwight Company, CHD. Do you know who they are?
No.
Okay. They are a $20 billion company. They do $6 billion in revenue, and they do $782 million in net income. I mean, should they really be part of the S&P? I don't know. Maybe, maybe not, but they're certainly not exciting.
Yeah, I mean, I really think next year they're going to have to make some choices to rebalance it properly, but it is weird the amount that they still have in there.
You know the SMCI is in the S&P 500?
Yeah.
I didn't know that. That I did not know. I mean, now we're starting to get into companies that everybody's going to know. But it is weird that Cheniere is not in the S&P. Marvell is not in the S&P. I think it's crazy SoFi is not in it at this point. Like, this is, I don't know.
Yeah, but you still love buying the S&P?
Yeah, because where else are you going to park money? I mean, you're getting, out of every 100,000 that you have in, you have $8,000 in freaking NVIDIA and 30 grand in the Mag 7 or so. I mean, pretty good deal.
Well, you could just buy the NASDAQ and really concentrate it.
Yeah, the NASDAQ 100 you could, which may be the play going forward for the next 5 years.
Yeah, like you know, the S&P is up 17% this year, but some of these names, not only did they not contribute, like the fact that the committee still has them in there is just bad management of this index.
You know what I'm gonna do? I want to do a stream with you. Hey, Matt Money. I sent you a text. You always say I don't freaking love you anymore, and I never ask you on. I sent you a text if you want to come on or not. You didn't text me. So don't start saying I didn't ask you on, Maddie. I see you in the chat. I see you.
Just send him the link, even if he didn't text back.
You know what? We're going to send Maddie the link. We're going to peer pressure him into coming on. I got to get WhatsApp open, though. We're going to pressure him into coming on. But I think what you and me need to do, Amit, I think one day we're going to need to make our own S&P 500 and find the largest companies in the U.S. and make a different S&P and see if it's any better.
You mean like as a thought project, right?
Yes, as a thought project.
Okay, because I didn't know if you were trying to compete with the S&P 500. That's a little different challenge.
I mean, I think we could. When I see this list, I think we absolutely could.
I think it's gonna be a little hard to get money into our new version.
Well, I didn't say it would be easy. I'm just saying I think that.
Would it be hard? What do you mean you didn't say? Like, what are you talking about?
I think that if I came up with 500, if you and me came up with 500 companies, it would probably outpace the S&P 500. Is what I'm saying.
Oh, I agree with that. But are there even 500 amazing? That's the other. Like, honestly, it needs to be 250. I feel like max. If you want, but there's just a lot of dead weight in the index.
There's so I'm looking at this. There's so much dead weight in the index.
No.
Like Church and Dwight is down 20% this year when the market's up.
It's crazy because Amazon's barely up this year as well.
Yeah,
still.
I know.
So it's like a lot of these names just haven't performed, but Amazon is a company I think most of us think will perform.
Yeah.
At that point. Yeah.
Well, all right. I'll let you go. I know you're trying to relax. Thank you for picking up. Want you to be part of the S&P rant because I think this is insane, the companies that are in here. So
it's a good rant. It makes sense.
We're going to have to do a thought experiment. I'm going to figure out a way to code something so we have everything on a big spreadsheet with their revenue, EBITDA, net income. We'll do the margins. I'll try to figure out the largest companies in the market, and we'll make a better S&P, and maybe we'll try to pitch it.
All right, let's do it.
All right. Enjoy the night. Talk to you later. Oh, by the way, I don't know if you were listening or not, but Josh Brown was talking about the ISR on, and I was like, if only Amit was here. I was like, his new nickname is Medium Rare. He will forever be known as Medium Rare. But I guarantee you, even though he is eating steak the way he should be eating steak, I guarantee you he could not tell us what movie that is from, what movie quote that is from.
Well, the chat spammed it. So
They did. But Lord of the Rings.
Honestly, I couldn't say 100% it was Lord of the Rings, but I had a feeling it was. But then I didn't know for sure.
Yeah, I mean, it makes sense.
Yeah.
All right. Well, Matt is backstage, but his devices are not connected, so I think he's screwing with me. I think he came on backstage and unplugged his devices just so I couldn't freaking say he didn't try to join.
That's actually hilarious.
It is hilarious.
Enough to do that.
And now he plugged his devices in, but he refuses to go on camera. Freaking Matt. All right, I'll talk to you later. Oh, man. So I think that's going to be a thought experiment. I mean, obviously, everybody still sees this up. I am really shocked at some of these companies. I really am. Yum Brands is a $40 billion company. Really? How many freaking devil dogs do they sell? I don't even know. Do they sell devil dogs? Is that from Yum? I actually don't know. Damn, that's an $8 billion revenue company. I didn't know that. Interesting. Well, I am a little shocked some of these companies didn't get in. Maddie, are you there?
Yes, Stephen. I want you to read the text message return that I gave to you and the time that I gave that to you so that I can see
Hold
the
on.
egg on your face.
Hold
Defaming
on.
me in front of all your followers.
Oh, shit. You know what? My phone is on silent.
Yeah, okay. No,
So
it's all talk, Stephen.
I will retract that statement. Maddie did text me back.
and I don't know
am gonna
what's
Hold
my
on.
my go ahead.
Hold on. I texted Maddie at 6:46, and I do not have a timestamp. I'm going to assume it was like 6:47 or something. Let me take the brisket off the smoker, is what he said. So that is my mistake because my phone is on silent because it was going off before.
You think you can message me, skip me immediately, go call Mitt, and then defame me in front of your followers? Why am I even on here? Why am I even on here, Steven? But I don't know what's going on. I keep trying to turn my camera on and it messes with my mic. I don't know what's going on with it. I might have to do a restart. I think I'm trying to do too much with this this 24/7 live stream. I need a separate computer to run that because I think my CPU is just getting overloaded.
Yes, well, Matt, I apologize. I did not see the text message.
No, I'm just over here and if you could see my face, there'd be tears.
There's not tears. You're really smoking a brisket right now?
Sad story. So I was smoking a brisket for about 6 hours, and then I think I need to lose. It's a brand new smoker. I think I need to do some diagnostics on it. I think it still works, but it kept dying on me, the pellet smoker, and so I had to finish it in the oven. So finished the last like 1/3 of it in the oven, and now it's just currently sitting on top of the oven, covered up and cooling off. It's at 194.
What type of smoker is it?
It's a Pit Boss.
Okay.
So I just got it. So I'm assuming it's historically known to like they over tweak the auger. So I need to go in there and maybe loosen up the auger a little bit. I got too excited. I turned it on. I should have done some diagnostics before I turned it on, make sure everything was working appropriate. It loaded, but it took a long time to load it, and I should have known then. But I got excited. I wanted to smoke my brisket, and so anyway, we're here. But I'll do some diagnostics on it tomorrow, and hopefully smoke some stuff for the Ohio State Indiana game tomorrow, which I heard is going to be good.
Ooh, Ohio State Indiana game. I love it.
Yeah. So aside from me being defamed, how else is the stream going? Is it going well?
It's going well. Little annoyed at the S&P 500 inclusion. And I got to tell you, going through the largest companies in the S&P, I'm a little shocked at a lot of the companies that are in here.
There's some zombie boys.
I would say there's a lot of zombie boys.
I am still quite surprised that Cheniere is not on there because, I mean, if you think about this, Stephen, the second largest export and soon to be the largest export in the United States is liquefied natural gas. And growing. We are now the number one exporter of LNG in the world. For people that are not familiar, surpassing Australia and surpassing Qatar. And for just showing an industrial sort of representation, I believe the S&P 500 should have a liquefied natural gas producer in it. And Cheniere has been profitable for a very long time. I'm just very surprised. It's a $50 billion company, very profitable. I'm just very surprised it has taken so long, and it's still not in there.
Do you know that Devon Energy is an S&P 500 component?
Devon's a great company, and in fact, you and I were talking about this the other day. Henry Hub Gas is on an absolute tear right now.
It is.
I'm upset. I haven't looked at the price, but I'm assuming I'm gonna be very upset with myself when I look at the price of Devon Energy.
But at the same time, I'm shocked that Devon is in and Cheniere isn't, is what I'm shocked at.
Actually, Stephen, Devon, I mean, it's on a move, but it's not.
It's not up as much as I thought it would be.
Yeah, it might be a good time, actually. I mean, it's up 20% from its lows, but
yeah, their reports, the next report's February. This may be a good entry point.
I don't know what their hedges look like though. So if depending on what their hedges look like, if they have a lot of spot, but these Devon's a great company, man. I'm surprised they honestly haven't got bought out yet. And if anything, I would assume that they're on the list of Chevron and Exxon to potentially acquire.
All right, well, just give me 1 sec. So thank you, Go Eagles 171 for the super chat. The last time I called a restaurant, the person asked me how I wanted my chicken breast cooked. All right, I certainly would not be calling them again or going to that restaurant. That's not
Go
happening.
Birds! Go Birds! No, I'm just kidding. I'm originally from Philadelphia, so all my buddies are Birds fans. So
They're all Birds fans.
Yeah, hopefully they turn the season around, man. They won the Super Bowl last year. They're performing like shit this year. So
And thank you, user Do7, for the super chat. Thanks for all the content, but this stream is so much comedy. Your crew is so funny. Congrats on all your success. Very proud of all you guys. Thank you very much. We try to make it fun and entertaining while actually giving insights to the stock market.
they call him Hot Steven for a reason.
So, Matt, I got to ask you a question from the chat.
Okay.
And I shouldn't ask you, but I'm going to ask you. It's funny. Steve, ask Matt if he enjoyed putting a good rub on his meat early this morning.
Steven, I took out hot sauce. And
how did you marinate the steak, the brisket? Would you use
well, first and foremost, I made sure to take it out of the fridge. This is my day, Steven. It's been a good one. You ready? Nice Friday.
I'm ready. I'm sitting down.
And I'm liking that quarter zip. What brand is that?
Ralph Lauren.
Oh, you think you're better than me? So I was actually looking at getting a Brooks Brothers quarter zip, and so I'm trying to decide.
I don't like the Brooks Brothers quarter zips. The 2 quarter zips I like, Peter Millar, Ralph Lauren. Those are the 2 go-tos for me.
You're a big guy on Peter Millar, and I know you're a Brooks Brothers guy, so I'm surprised to hear.
All of my, or most of my polos are Peter Millar. I love that company.
Did you see the new quilted, like diamond quilted quarter zip from Brooks Brothers though? That's what I'm looking at.
No, I haven't.
That is like a classy. But I will say before I get into how great my Friday was, because it was better than yours. Just kidding. But I did get a dark green money looking suit jacket that's supposed to be coming in next week, and I'm excited to walk into work like that, looking like I own the entire company. And you know the company I work for, and people are gonna be like, "Oh, this guy, is he run this place now? Like, what is going on?" I'll be the president of UDOC within weeks. I promise.
All of my button-down shirts and sport jackets are all from Brooks Brothers.
See,
great.
Steven,
they make great stuff. They make great stuff.
You're a good man. So my Friday has been a pretty good one. I mean, I did work today, so it wasn't entirely phenomenal. The only thing I didn't do was smoke a cigar, but that's on me. I could have easily have gone and smoked one. But woke up, took a couple meetings, said, you know what? I need to get this thing on the smoker, meaning the brisket. Took it out of the fridge, let it warm up a little bit, left the house, got a Jersey special from a bagel shop near me. Not really near me. It's 10-15 minutes away. But best bagel shop that I have nearby. The other one would probably be like 20-25 minutes, unfortunately. So I went to this one instead. Which the Jersey special is Taylor pork roll, egg, and a little bit of cheese, ketchup, pepper, salt. And then I came home, put some hot sauce on that bad boy, and crushed that. Actually, that's a lie. Came home, seasoned the brisket first, got some Frank's Red Hot wing sauce as a light binder to keep the salt and pepper on it, loaded it up with 50% salt, 50% pepper as the seasoning. Nothing crazier than that. That's what a lot of the classic barbecue joints do down here. And then made sure that the smoker got up to temp, put it at 295. And then it's just a point, by the way. It's not a full brisket. It's just a brisket point, which for anybody that knows, a brisket's actually 2 muscles. It's a flat and a point. The flat is what like the really lean slices you get are. And then the point is like the marblier, fattier side of it. It's kind of where like the chest of the cow is, I think. And so versus I think the flat is like once it turns into the upper part of the leg, I believe. So the point is a little bit more marbly, And if anybody's ever had bird tens before, they cut those up and they cube it up and then they re-put it into a smoker with some like barbecue sauce or stuff like that. But I'm not doing that. I'm just gonna have the regular old point. But it cooks a lot faster, obviously, because it's a single muscle rather than the two, and it's a lot smaller. So yeah, that's that. And once I got that on the smoker, I went upstairs and I enjoyed my Jersey Special bagel on sesame. I wish I could do more everything, but I'm always afraid that I'll hit a drug test or something and the poppy seeds will make me test positive or something.
Come on,
like that.
that's a freaking wise tale. That's not real.
Nah, Steven, it's been proven.
It's
been proven, Steven.
It's not real.
It was already trimmed when I got it from the butcher because I'm rich. And then for anybody that's saying, oh, I didn't trim it, it was trimmed. And then it could have done a little bit more trimming on the fat cap. There was a part where I was like, meh, should I trim that? But I was too lazy. And the rest of my day has been great. Yep, and he killed himself. Oh, sorry. Shouldn't say that. He offed himself. Yep, he's coming back.
I don't know what I hit there. That's crazy.
Tell. That's what you did.
So, how do you feel about SoFi not getting in? Do you care?
SoFi is a great company, and I really hope that a lot of people continue to do well. What am I going to say here?
Ladies and gentlemen, Matty makes money is choosing his words wisely because he has a bet that ends in 26 days from now.
I forgot about that bet.
And he needs this to go under $25. Everybody was ragging on him not too long ago saying, Matty, you made a bad bet. I got to tell you, he may win this bet, everybody.
Is it going down? What's going on?
I mean, it's at 27.5.
I mean, if it stays above 25, Steven, I might not financially recover. And that's that. I might have to sell my house.
I mean,
but no, in all reality, I like SoFi. I was on a stream earlier on Wolf Financial. They do a daily stream as well. And Evan from Stock Market News was on and he invited me on. And so it's good to chat with him because I've never done a live with him before. And, I really like SoFi. If I had 2 or 3 more companies in my portfolio, SoFi would be in there. But I just keep such a small focus group, which people don't like about me because I think people always want to know what else I would invest in. And so they always get frustrated that I always talk the same stocks, but I really only have like 7-8 stocks in my portfolio.
Okay. How are you doing in your Amazon position?
My Amazon?
Yeah.
Let's see. I'll tell you, let me see how I'm doing overall because I was down 10% yesterday, which was still like a big chunk of money.
Are you still buying?
What, Amazon?
Yeah.
Steven, is that a question?
I'm just making sure.
I'm not buying Google here, I'll say that much. And I'm happy because the returns I'm still down 11, which is a good amount of money. More than the value of my house. But what was I gonna say? You were gonna ask something.
No, I was gonna ask you if you saw that I downgraded Alphabet.
That you did? Yeah, I saw that. I saw you talking the other night, and I don't disagree with you there, Steven. I mean, the reason why you and I were so hopped up on it is because it was trading at like a 20-something, low 20s, which everything else at the time in the Mag 7, 12 to 18 months ago, was trading in the high 30s, and I think Apple was trading at like 38, so was Microsoft or something like that. And Alphabet was trading like 21 or maybe even less. Trailing 12 months,
17 times forward.
Probably, yeah. It was stupidly cheap.
It was low.
And everyone was like, "It's going to zero," and I was like, "I'll gamble." And so, at some point, I sold something. I don't know what I sold. I should go back and look. But at some point, I sold and I bought like another 150, 200 shares, and I'm happy I did because for a long time I only had like 400 shares of both Amazon and Google, and then at some point I sold something and I got my share count of Google over 6. I think it's 600.
Nice.
So it's a pretty chunky position. My Google, but my Amazon. Oh, that's a lie. I don't have as much Google. I thought I had over 600 shares. Maybe I'm thinking of Amazon. Amazon, I have over 600. Google, I do not have 600, but I have close. But they're both pretty chunky positions for me now, which is great because they're about. I mean, yes, there's some appreciation in here, but when I was first getting in them, they were only like $30,000-$40,000 positions. Now they're both about $150,000 a piece. So
I like it. I mean, look, I think Alphabet is going to do well. I think it's going to continue to go up. I think it's going to keep pace with the market for a while. It's no longer the alpha that you could have gotten before. And before, the bears were creating a case of search is getting cannibalized, this company is going to keep going down. And that just wasn't the case. And they were creating a false narrative because search's revenue continued to grow quarter over quarter. And the numbers just got to the point where it was very undervalued. Now, I'd say it's very close to fair value, and it'll just gradually increase. I mean, to me, it's not going to double for quite some time from here. But Meta, on the other hand, is in a position where, look, it was under 600. Look where it is now, 660, 670. And after Q4 earnings come out, I think Meta is going to be in a really good position where it's going to keep going up considerably.
6.7, Steven. You said it.
Meta's the play right now. Still is. Meta and NVIDIA.
Man, I am these top 5 stocks I have in my portfolio, it's a lot of money, Steven. I'm just looking at I mean, I knew I was concentrated, but that's concentration.
Listen, I keep telling you, if I had your money, I'd donate mine.
You say that. But I don't know if it's true.
I mean, I think it's true. If I had your money, I'd donate mine.
Got a point.
I mean,
I'm getting there, Steven. If I have another double, we'll be happy. You guys might not hear from me anymore. I might be like only talking on CNBC.
I mean, listen, you're the type of guy that when you go get brisket, your brisket is trimmed.
It's trimmed.
It's trimmed.
You know what else is trimmed, Steven?
I have no idea.
Neither do I. I don't know. I was just saying stuff.
But when you go get brisket, you don't even have to carve it up. It's ready to go. So what are we looking at, Matt? I'm a little shocked that Cheniere didn't get in. I'm not surprised SoFi didn't get in, but I am surprised Carvana got in. And after looking at the S&P, my biggest surprise is that they didn't rebalance it more. I think there's a lot of dead weight in the S&P, and maybe we need like a S&P 200 or something, not a 500. Maybe 500 is just too many companies to have in the index.
It's actually very interesting. I've done some tweets in the past when I was really starting to really look into this, and I do like the S&P 500. But the thing that's most peculiar is if you go back to the 70s, the S&P 10, so the 10 largest companies, it changes every decade. The only decades that it never changed, where the top number one is consistently changing, is actually 2010 and 2020. And well, I mean, they changed, but Apple was still the number one company or very close to it in 2010, and it obviously is one of the largest companies now. The only thing I will say is that when you get to now, NVIDIA showed up, which it was not in 2010 or 2020, which is pretty interesting. But it's peculiar to kind of understand, like in the top 10, there's always a trend. So in the 90s and 2000s, it was very much industrial conglomerates. That was a big thing. Now we have kind of these technology conglomerates that have taken and replaced those industrial conglomerates, which is really interesting. And because you used to have the GEs of the world and a lot of these other companies that were massive, And then obviously Exxon was up there as well with Microsoft. And then 2010, Microsoft was still obviously up there, but Exxon had kind of settled down a little bit. But I think it was still up there. It's still a pretty big company. Then you had these other players like the Googles and the Amazons of the world kind of coming to poke their heads. And now it's strictly the top 10 is strictly pretty much technology, which is interesting.
Yeah, and look, Apple and Microsoft have been two of the largest companies for a very long time. And I think the technology, we are in a much different era than we used to be. Technology is just going to dominate the S&P 500 for the top 10, top 20 slots. I just don't see a world where it doesn't.
What are you buying, Steven? I'm pretty upset with myself, I will say, before you answer that. When I was at home, I think this was Wednesday last week, so just about 10 days ago, when Meta started its rebound, I had sold a $700 put on it because I didn't have any cash, but I still wanted to make money from the move on Meta. And I thought about selling two of them, and I just didn't, because that's obviously, in collateral, it's $140,000. I'm like, I'm mid-drive right now. I wasn't really like sitting and thinking clearly. And in retrospect, I wish I'd sold one. And actually, I don't really know how Meta's performed. So maybe when the market opens up on Monday, depending on where it's at, I might sell a second one.
I mean, I think Meta's really.
It's at 670. Fuck. God damn it, Steven. I wish I had sold the second one.
Yeah. I told you it was around 670. You don't listen?
6.7, Steven. 6.7.
6.7. 6.7. I mean, hold on. I'm going to bring this up.
Bring it up, Steven.
Look at the top companies. Do you really see this changing? I don't.
Robotics could come through.
Do you think Walmart's becoming a bigger company than freaking Meta or Amazon? I don't. Eli Lilly, Visa, Oracle, Exxon? No. I don't think these companies
I'll say I'm impressed by Walmart being at $900 billion. That is impressive.
I am too.
I mean, I get it. They are doing a good job, and to be fair, I do use Walmart Plus. Shout out Walmart Plus. I also have Amazon, but Walmart Plus actually does a pretty decent job of getting your deliveries to your door.
But in all seriousness, look at the huge drop off. You got multi-trillion-dollar companies, and then you got companies that are in the mid to high trillions. And then it's just such a steep drop off. I mean, Visa's 634, and then it goes from 620 with Oracle to 491 with Exxon. I mean,
Steven, I'm going to push back on what Amit said, and I think you're going to agree with this. I think we have such a strong community that we should create our own S&P 500. And
I think we should.
And the S&P 500, what we should do is actually look at the S&P 500 as it is, and then remove the companies that we don't want. So I think it'd be very easy, actually, and it could be managed, but we could literally be like, Carvana? No, we're not adding that.
You know what we should do? We should take VOO and take VTI, so the Vanguard S&P and the Vanguard Total Market. We should 86 every company from the S&P 500 that we don't want, and then go to VTI, since that's like 3,000 holdings or something like that, and pick companies from VTI to throw in there.
Interesting. Is there a requirement to be in VTI? I don't think there is any. I think it's just a total stock market.
I think it's a total market.
I don't think you can be an ADR, right? But I believe it's not like the S&P. I believe it's just every stock that you can imagine.
3,533 companies.
So it's not all companies, but it's a lot of them. What is it missing? I forget what the missing is.
I don't know, but I think it's a combination of large, mid, and small cap.
Ooh, I like that. A top 100.
The YouTube, dude, the YouTube 250. I like it.
What do you mean YouTube 250? Oh, that's what we would call it. I like that.
YouTube 250. I like it.
I like that. And that would be a cool thing that we could do every quarter, where it's just like we rebalance it every quarter. Actually, screw it. Every time the S&P rebalances, we rebalance. and we can choose the top 250 that we like. I say we start with the S&P 500 as a base. We don't add anything that's not in the S&P unless you think that that's stupid.
I mean, I shouldn't even say what I'm thinking.
Say what you're thinking, Steven.
I shouldn't even say what I'm thinking because
we're changing the game right here.
Oh my God. Depending on how many companies we actually do, I can't believe I'm going to say this. I don't think I'm going to say it. All right, I'm going to say it because I don't want to act like I'm teasing. I was going to say that depending on how many companies we pick, I would just buy a share of every company and make it a public portfolio. But after running the math, I don't think I want to do that.
Well,
if we did 50 companies, that's one thing. But doing 500 companies, I don't want to do that.
Yeah, it's a lot.
But yeah, depending on how many companies we do, maybe I'll make a public portfolio out of it.
And just choose which ones you do and don't like. I like
no,
it.
I'll do it on a platform where I can buy a fraction of shares and I don't have to buy. Ooh, that's an interesting idea. Okay. We make a YouTube 250 or something like that. I'll open up an account where you don't have to buy it by the share, and I'll just pick an amount of money, buy fractional shares, same amount, equal weight of all those companies, and see if it outpaces the S&P.
I forget what I have to go back and check my post, but I think the S&P 500, the S&P 100 always outpaces the S&P. I think that there's at some point a detrimental return somewhere. I forget what that number is.
Give me a sec. Rich Buddy, quote, "You never have more than 26 to 28 stacks. That's just the rule, brah. Got news for you, brah. Got way more individual stocks than that."
Yeah, Steven, he'll research a stock. He'll be like, I have to buy it.
You want
your dividend portfolio? I don't think you talk about your dividend portfolio enough, Steven.
I don't.
You have like over 100 stocks in there.
I do. New article dropped this morning. The stats are pretty crazy. I mean, let me show you these stats.
It's a good one, man. I like that. I like that series. Probably that's my favorite series you do. Well, I guess it's the only series you do.
So I dropped this today. It was a day late. I got caught up last weekend. So I started a portfolio from scratch because, and maybe I'll make a YouTube series out of this, but I started with $100 and I used to write, and I still write a lot of dividend and income focused articles on Seeking Alpha. And a lot of people would say, but you have to have so much money to make income investing work for you. So I started a series on here where I started with $100 and I put $100 a week in it. And I've been doing it for 248 weeks. And I've invested $24,800 in it. I am not trying to beat the S&P. I'm not trying to match the market. My goals are to build out a diversified portfolio that can mitigate downside risk, that generates reoccurring income with capital appreciation as a secondary objective. And when I show you the stats on this, I think you're going to be a little surprised. And if you go read the article and put a comment in there, I will read the comment and respond. I do a crazy amount of analytics on this series. It's probably the one thing I put a lot of time into a lot of things, but I put a tremendous amount of time into this series. And I give you the play-by-play. I give you the trade-by-trade, all the income generated every week. So here is just a chart of where it's been throughout its entire lifespan. The blue line is invested capital, the red line is the current account balance, and the yellow line is the forward dividend income. This portfolio is now generating $2,770 in forward income. And this is one of the coolest charts. This is the monthly income every month since inception that it's generated. And if you look at the past 2 months, October and November, the year-over-year growth in monthly dividend income being generated is huge. And the snowball effect is really starting to happen. Every dividend gets reinvested. It's all on drip. I mean, there's a ton of positions in there in the green that are generating more than one share a year that is just getting compounded back in. And this chart is one of my favorites. I'll try to make it a little bigger. It's hard, but if you go read it, you can click on it. I mean, you look at Altria Group, and I have not added to Altria Group since February 2024. It is still my largest holding. I've purchased 18 shares of it at an average price of $44.54. Since then, it's generated 28.32% of his initial capital in dividends that have been reinvested, and it's generated 4.5 shares.
Love that.
Now, this series, look, this is not going to be for everybody, okay? But there is a huge S curve happening with the dividend income being generated on a forward basis every week. And then when I look at the projected, I mean, every hour this portfolio generates 32 cents. Daily, $7.59. It can go buy me a value meal. And every week the average is $53. So it's an interesting series. I'm planning on continuing to do this for another 10 or 20 years. So we'll see where we get it. Maybe I'll
It's
start
$100 a week, right?
$100 a week.
People can do that.
$100 a week. You know, it's just one of those things that I wanted to start to show everybody that you can start at zero. You don't need a lot of money. And over time, you can build out a pretty good dividend income producing portfolio. And I have stuff in there that's only generating 2 or 3% yields. I'm actually thinking about doing a bottom 10% RIF this year and doing a RIF every year at the end of the year and just getting rid of the bottom 10%. So we'll see. But
10% in terms of performance or yield?
Performance.
Okay. Yeah.
I'm thinking about adding some stuff to it now.
But I think that, Stephen, this is another way to look at it, which I think is beautiful. So on average, you're generating over $200 a month at this point, which is phenomenal. But you think about it, it's like you're adding 100, pretty much 100, maybe. Well, I guess it's 100 a week, and that probably averages between $450 a month on average. Because some months will be 400, some will be 500. But you think about it, you're getting back 50% every month now of what you initially were putting in, which is massive. You think about it, in 4 to 5 years, if somebody were to if you were to tell me, you're like, oh, I can't do it. It's like, figure out a fucking way where you could put away $1,000 or $2,000 for 4 to 5 years, and you're telling me you're going to be making $500 to $1,000 in 5 years' time per month. I think that's a great opportunity. That just shows you that if you hustle and you put your goddamn money where your mouth is, you can make some pretty good money. Like, you think about it, and that stream is going to be growing. And for people that don't know, I was a dividend investor when I first started, very comparable what Steve is doing here. And I recognized, I was like, well, if I'm going to play Monopoly, I'm going to play Monopoly. And that's when I kind of switched a little bit to growth. But at one point, I was projected to make over $30,000 a year in dividends. This is back in 2020, 2021. I was like, actually, let me pivot a little bit, and I'll come back to dividends a little later in life. But the thought process that I saw is like, when you're making, let's just say $10,000 a year in dividends, and you're not taking it, and you have like a 5-6% yield on that money alone, just reinvested before there's any dividend growth or anything like that, that $10,000 will net you an additional $500 to $600 the following year before you even do any additional contributions. And then if you have good dividend growth companies, which the hope is that you're not buying into these, these SPY teas and things of the world where, you might get dividend cuts or something like that. And you have like a declining dividend yield over time. The hope is that you have good, high quality dividend companies that are lower to medium sized payout ratios that continue to grow their EPS so they can continue to grow the dividend. Those guys are going to increase the dividend 6 to 10% per annum. So next thing you know, that $10,000 just before you even step through the door the following year, you're going to be making $11,000 to $12,000 in dividend income before you invest another dollar. And that's just because of the dividend growth and also the dividend reinvestment. And so it really snowballs. Like if you really get a couple years in, it gets pretty insane because you think about it, then you do it on say $30,000. $30,000, you're going to get an additional, I'm not smart with math, Steven, so you're probably better than me. But
you're damn good, Matt. Stop it.
$1,500 to $2,000 just for if you have a 5 to 6% dividend yield portfolio, and that's just reinvesting, so you're gonna get another $1,500 to $2,000 the following year, and then let's say 6 to 10% year over year, say dividend growth. I mean, you're talking about going from $30,000 to $35,000 very quickly, just because you set aside a good amount of money. So, I mean, this is something that it's a different way to think about investing, but it's a very interesting way, and I think it's a lot of fun. I had a lot of fun being a dividend investor because you see the immediate results versus what we do now or what I do now with some of these other things that you have to ebb and flow and trust, and it's a little bit different. But I loved it. I loved being a dividend investor. I miss it a lot of times, but I've obviously done it really well doing what I've been doing now. So
yeah, and look, what I want to say about the dividend investing, it's not for everybody. Okay, I have a much different investment philosophy than other people because I look at my capital as tranches, not 100% boom bust. Have to go try to maximize your net worth every second of every day. And the reason I do is because when I look at how I structure everything, 100% of my retirement is in the S&P 500. That is a hedge against myself, okay? That is, if I blow up all my accounts and I completely screw up, I still know that I am going to be able to retire comfortably off of those investments. And just to give everybody an idea, if you're in a position where, and keep in mind right now, you can max out at $2,000 a month, 24,000 a year. I think next year they're upping it to 24,500. Okay.
Same.
If you put at an 11% rate of return, which we've been getting, but if we drop it down to 10%, you're going to be able to turn money over 25 years, starting at zero, into $2.5 million. You get that up to 12% if we enter like a real long bull market, over $3 million. So for me, being in growth, being in dividends on the side helps. So I fully believe if you're in a company or if you have your own business, your retirement account, save for your retirement. That's why I'm able to invest in companies like SoFi and Palantir and these other companies, because I am putting into the S&P all the time. Now, dividends are just one aspect of things because I do not have private business, right? So, and I don't like real estate. So I don't want to be a landlord like Maddie, who owns the world. So I have dividend income coming in. And that portfolio is a public portfolio that I built to show everybody how I would build a dividend portfolio from the ground up, from scratch. And when I look at the actual numbers from it in my spreadsheet, because obviously I have to track everything for that series. Right now, in week 248, I've allocated $24,800. It finished the week with an account value of $32,939.88, generating $2,770 in forward income. It's up 32.82% on invested capital. The net profit so far is $8,139, and I have a 11.17% yield on cost. That's yield on invested capital, and the portfolio yield is 8.41%. Now I could sell everything and get this money and redistribute it across stuff, or I can just keep doing what I'm doing. To have an 8.4% yield across the 105 positions, you can get a dividend cut here and there, and it's not going to hurt you at all. A lot of these companies raise dividends, and a lot of them stay stagnant. I mean, I got a bunch of covered call ETFs in here. I have a lot of closed-end funds in here. I mean, if I showed you, I'll show you the actual companies in here. So I'm not going to go through all of it, but like BDCs, I got Ares Capital, Owl Rock, FSKKR, BlackRock Secured Lending, Goldman Sachs, BDC, Main Street Capital, Barings, Prospect Capital, and Crescent Capital. Closed-end funds, I got a lot of closed-end funds here. Now, some of them, there's a lot more money in it than others. I really like the PIMCO stuff. I love the BlackRock Science and Technology Trust. So this one and PDI are probably my two largest. But there's a lot of these. I've recently been named Adams Diversified Equity. I mean, there's a lot of stuff in here that I have. And it's a very diversified portfolio. And it's something that I enjoy doing. Maybe I'll do a dividend series on YouTube. Maybe I'll do a YouTube portfolio. We'll see. Maddie, do you think I should?
I am. I think to offset the cost, we should all do it together, because otherwise it's just going to be too much for one person. But if you think, oh, you mean just not actually like a real one, just like a fake like practice one? Yeah, if it's
no, I'm going to do. I'm thinking about doing a real one on YouTube.
Well, no, I meant like a real ETF that people can invest in. But,
I mean, you know, I want to do that.
I do too, but yeah, no, yeah, give it a try. I think that's really good. I also think that there's something to be said about dividend growth companies. I think there's a sweet spot of like things that yield 0.5% to 3.5%. Actual companies, not BDCs. BDCs are a little different, but actual companies that yield between 0.5% and 3.5%, and grow dividends by 5 to 10% or more a year. I think there's a sweet spot of companies that you'll outpace the S&P. And I think a lot of it has to do with companies that are in that sort of situation yield enough where they're super focused on growing EPS, but also at the same time being mindful that they don't get too crazy with their dividend investment. And there's some companies that are unfortunately just more mature, like Altria Group. I don't want to talk poorly about Altria Group, but it's just a mature business, and so they don't have a lot of opportunity to reinvest other than say diversify. But it's still a great business to own, and that's obviously going to have a high yield. So unfortunately, it might not show up on that list. But I believe that great companies that are youthful, that are hitting some sort of mature stage where they're just expanding at this point, they found a good market. That they continue to grow dividends. I think there's a really good sweet spot there of companies like Discover for a long time was in that. I haven't really caught up with Discover in a long time, but there was just a lot of companies that if you look, it's something that you can rely on pretty heavily. But I think this is
the public company. Look at this. No company has the ticker MLKG, Milk Gang. I gotta make a public company now.
You gotta be it. You gotta do it. But I want to say that the thing that I think that a lot of people can take away from these dividend investments is it's more about the yield that you get, and I think it aligns very well, specifically for the people that are slightly older. Excuse me, in their journeys than say some others, where they're more so focused about getting that 3 to 4% per annum, which I think is what everyone should look for. Is how is your portfolio on an annual basis going to generate you 3 to 4% that you could live off of it forever? That's always where I'm kind of my mind is at. Like, is your portfolio enough where if you were to retire and stop contributing, you could take 3 to 4% per annum and be okay? And so I think that's where everyone should kind of look. So how much are your expenses? Let's just say it's $100,000 a year. then, for $100,000 a year in income, you're going to need probably close to $2.5 to $3 million to be able to live sustainably at $100,000 a year. And I think a lot of people with dividend investing, that can help people realize that you don't always need to sell the stock. I think so many people are like, "Oh, what point do you sell? What point do you sell?" And I think so many people are so obsessed with like trying to sell their stock. And I think the beauty of dividend investing allows you to think that you don't need to, right? Like you can find a good portfolio of stocks that yield 2.5% to 3.5%, write some covered calls, and live on that portfolio, and it'll generate you 4.5% to 5%, and it's beautiful. And I think that that's something that a lot of people should actually aspire to, rather than being in this world where they're arbitraging in and out, swing trading, etc. And I feel like if they master that, then they'll likely be a lot happier and also sleep better at night.
So, did you ever see the analysis that I did on Johnson & Johnson, the Schwab U.S. Dividend Equity ETF, Altria Group, Neos NASDAQ 100 High Income, and then JEPQ, the JP Morgan NASDAQ Equity Premium? Did I ever show you this?
What is it, like a proprietary blend that you're trying to come up with?
No. Did you ever see the analysis I put together on this?
I don't recall.
So I'm going to link it in the chat. It's probably a little bit stale now, but I wrote this up on my newsletter.
I did read this one. I did. Yeah.
It is eye-opening. And look, I made some assumptions with this. So the big thing around this, and I do think it's worth reading if you're into dividend stuff, just a different way of looking at things. It's pretty freaking interesting. But I'm going to show you something, because the math doesn't always favor prioritizing track records spanning decades with low annualized growth or yields. So if you take Johnson & Johnson, and keep in mind, I'm making a pretty big assumption on this, that the share price just stays stagnant, because I'm not going to try to forecast it. But based off of their dividend growth of 5.4% and where it goes, okay?
Julie, thank you for your contributions to the chat. Sorry to interrupt you, Steve, but Julie's great. I love Julie.
No problem. So it's really freaking interesting where you get to on the dividend. So I did Altria, the Schwab one. It's really freaking interesting how much the dividend income actually becomes growing it out based on the shares if you put 100 grand in, and where the dividend income is year 1 versus year 29. That's not even with reinvesting. That's just with the average growth rate. So like if you're going to live off of this Altria Group based on the average growth rate, if share price doesn't really matter because you're not reinvesting. But if you were to put 100 grand in and get almost 1,500 shares, in year 1, your dividend payment would be 6,000, and then in 31, it would be 19,000. Now, yes, that's a long time, but that shows you how much your dividend is growing throughout time. Now, Schwab, you're going to start out at 37.44, but you're going to end up getting 82,750 in year 31. And that goes to Matt's point, because Schwab is about a 3.6, 3.8% yield, but their 5-year average dividend growth is 10.87%. I'll zoom in just a little more. I can't zoom in a little more, but that dividend payment in year 2 goes up. So the main reason why people love dividend, especially dividend growth, is because you're getting a raise for doing nothing every year. And after 10 years, that dividend payment went from $3,744 to $10,507. You're almost at $1,000 a month without having to put any more money in. But you keep getting a raise. So if you retire at 60 and you put 100 grand in Schwab, theoretically, based off of the 5-year average annual growth rate, by the time you're 91, this will be paying you $82,750 rather than 37.44. Huge difference, like an absolute huge difference. And then you get something to like QQQI. I thought I put that in here somewhere. I just did QQQI off of a 5-year, but I mean, 100 grand on QQQI is 14 grand a year. So it really depends what you're looking for. You can go high yield, but there's no growth on this. And QQQI is a whole different animal that I could get into. But there's a lot of different ways with dividend income and dividend reinvesting that we could go down. Maybe I'll do an entire series on that. Seems like the chat wants me to do a public YouTube portfolio. Maybe I'll free up some capital. I'll take this under advisement. 88% of the people want it. So maybe we'll do a full YouTube series about building out a portfolio. I got to think about if I'm going to build one to beat the S&P, if I'm going to build one for income. I got to figure out what I'm going to do, how I'm going to do it. But
that's the thing. I mean, that's what I don't think people realize is that like you have to go into a portfolio when you're building out some of these things with the objective, right?
100%.
Time horizon. And I think there's so many people that are just like, oh, there's one way, there's one size fits all. It's like if there was a one size fits all, there would be books, right? But there's so many different ways and where you are in maturity of your portfolio that you can invest. And I think that people really need to be conscious. Like just because Steve likes Altria Group doesn't mean you should, right? I think Altria Group's great.
Does not mean that you should like it. If I could give any piece of advice, the only piece of advice that you should listen to is go find a partner who you love and a partner that has the same type of goals, because automatically you're basically now getting 2 incomes and hopefully 2 people that are putting away for retirement. It's the easiest money hack you'll ever get.
Well, I don't necessarily. My wife, if I ever get one, well, she could choose to work if she wants, but she doesn't have to. But Steve, you know one of the things that I like about you?
What?
You keep it 100 on the land, the sea, the sky, and you pledge allegiance to your hands, your team, your vibes. You don't care where the hell you've been, because now you're mine. And it's about to be the sleepless night you've been dreaming of.
I don't even know what the hell you're saying.
Oh, okay.
But, I mean, listen, at the end of the day, there is not one size fits all. But putting it, at least for me, what works for me is maxing out with an S&P 500 ETF in the retirement, because that allows you to do other things, because no matter what you do, you should theoretically be good. And that also allows you to do a lot of different creative things with your other capital. And 2 of the things that I'm doing is, one, building out, look, those are obviously not my only income dividend investments. That's a series that I started from the ground up that I continue to do because I'm documenting something. But part of the money is in dividend stuff, part of the money is in growth stuff, part of the money is in other stuff. And for me, it's more, and Matt and I are very alike on this, it is a goal for the future.
Hey man, my hope is that I never have to sell a lot of these stocks. I mean,
same here.
I originally was in the boat where a lot of people are like, oh, when do I sell it? And it's like, well, if you're invested in the right companies, you might not ever have to. Like, why would I sell Google? Or as long as interest rates are cheap, right? Like borrowing money is cheap. And what rich people do is they borrow against it. They don't, I think it's very interesting. You can do an easy exercise where, and for people that are wondering, like, what am I smoking? That's a Taylor Swift song that I quoted to Steve. But what was I going to say? If you do a simple exercise, people are like, oh, well, I want to buy a house. I want to put a down payment. It's like, if you invest that $200,000, that $200,000 is locked up in that house forever. And that might be a good investment, depending on where it is and things of the like. But let's just say the market does return that 8 to 10% per annum, and you keep that 200 grand in there. It's like, well, let's just take 10% because it's easier. That 200 grand can continue to appreciate at $20,000 per year. And if you're borrowing at, say, 5%, you could easily, pay that potentially off over time. And so while your money is still appreciating at 200 grand a year, yes, you still have to pay some of that, but you can use, and some years might be up, some years might be down, but you don't necessarily have to sell off the principal. The principal can continue to grow, and that's the beauty of it. And you don't even have to pay it off. That's the nice thing, is like, so many people are like, oh, well, I had to pay it off. It's like, well, technically, no. As long as interest rates stay low and you're able to borrow money at 5%, why would you ever pay that back potentially? You could just keep accumulating that money. So it's like, if you have a $2 million or $3 million portfolio and you need the down payment, borrow your 200 grand. And now if you die, like, then yeah, your family could pay off that $200,000 debt. But for you can keep that money in the market and it still grows at about a 10% or 8 to 10%. And you're coming out at positive in the end. So I think people need to start thinking about things more like that, and they'll make very different choices. That's the way I've started to recognize things, is like, well, if I ever needed money for something, and I've done this many a times, I borrow against my 401k like a madman. I've bought in multiple properties, as people may or may not know. It's not a humble brag. This is just the reality. And most of the time I do that, I borrow against my 401k. And because the 401k allows me to borrow quick, cheap money, and then I just pay it back with my paycheck. And then when I have more money, I go say, hey, I have more money for another house, and I go buy another one. And the portfolio is there. As long as you're doing leverage safe, then you can really help expand your wealth. But I see so many people trying to sell stocks, and the hope is, for me, yes, there's going to be opportunities let's say you get all the value up front, like some of these SMR and stuff like that. If it's still speculative, you don't think it's going to go anywhere, take your money and trim. It's been something I said, 3-4 months ago, and I'm sure some of these SMR stocks might return, some of them might not. But if you're getting a lot of value up front, like years, decades even of potential growth without any actual money showing through the door, then sure, take your money and run. But I see a lot of people being like, oh, I got to sell Google here. It's like, you realize, especially in a taxable account, say you bought Google 12 months ago in short-term capital gains, and you put 100 grand in, and now it's gone to $200,000 to $250,000, and you sell it. Well, first and foremost, you're going to have to pay the tax man probably close to $45,000 in taxes on that $150,000, because 30% tax. And then if you think about it, you're not just going to need Google to drop by 5% before you can buy back in, right? You're going to have to wait for Google to drop. Let me just do some math here, Steve. I'm not that smart, so give me a second. Minus 45 divided by 250. You're going to have Google drop by close to 20%. 20% if before you even start to break even on those shares. And what do I mean by that? You sold it, you're $250,000. You had to pay $45,000 in taxes. So before you even break even, the stock has to drop by 18% because of how much money you've lost due to the inefficiencies of taxes. Now, taxes are inevitable. So I'm not saying, you kind of have to take this with a grain of salt. I'm not saying don't ever sell because of taxes. What I am saying is like, instead of just selling that 250 grand, borrow $5,000 to $10,000 if you need $5,000 to $10,000 and pay it back over time, or don't, versus having to sell it, pay capital gains on $150,000 to the bank. Like it just doesn't make sense. So, and then you would need the stock to drop by 82% before you break even. Like I see so many times people think that they're doing themselves a favor. It's like, ooh, I was up 100%. I sold and I bought back at 5% cheaper. It's like, well, you just fucked yourself. Unless it's a tax-free or tax advantage account, you actually lost money on that trade. And I don't think people often think about that. Sorry.
Good analysis. No, I like it. So I guess I'll
tell you one thing I've been doing, Steven, actually, which is pretty happy now that I've paid back some of the debts that I have on my portfolio, because I paid back my 401k after I bought a house in May. So I actually have been writing now that my options are kind of like hitting directly the piggy bank. I'm putting all the options income, 40% of it into a tax savings account to save for taxes, and the other 60% I'm putting into a dividend portfolio. And the hope is that whatever I generate from that, I'll be able to get decent dividends, and that'll be what I use to have my play money. So like if it ends up generating $1,000 a month or $2,000 a month, that's what I'll use to buy a cool car or to buy, a vacation or something. That'll be fun. So now I'm actually starting to generate that play account.
Maddie's I'm not going to say which one, but Maddie's going to be looking at some cars soon, I feel like.
I go back and forth on that, Steve. I'm like, it would be cool, but at the same time, it's like more money, more problems, like more shit. Like I have a very small house. Like I don't know where I would put all this stuff. I might have to buy the different house before I buy it.
I mean, I feel like that's coming sooner or later now.
If I buy a house, it'd be closer to you, man. It'd be like within 2.5 hour drive, and maybe I'll be driving this fancy car to New York to come see you.
I mean, you should.
Yeah.
You should. Why not?
Yeah. Need to be more like you, Steve.
I mean, I think that you should come up to the Northeast. I think it would be good for you.
Tevi and I were actually talking about coming to see you. I've never done Christmas in New York, and I would love to see the lights.
I mean, I think that would be a bad time to come up.
For you, for work? Or?
No, I'm just saying, like, you really want to be in the city during Christmas?
No, I mean, I'm not saying, like, stay for a week or anything. I'm just saying stop by.
Oh, listen, if you want to come beforehand, I think that would be great. It's really cool. I'm just saying around Christmas time gets crazy here. That's all.
Does it? Okay.
Yeah.
Well, I mean, I don't know exactly what's going to happen. Like the 19th or so is when I'm done work for the year. I'm flying up the 20th, 21st. I need to book my ticket still. But, I mean, it's from the beach house. It's really not that far to New York. It's only like 2.5 hours.
Notice how he said the beach house, everybody.
There's a couple of them, Steven. I don't know what to do.
I say, if I had your money, I'd donate mine.
I mean, they're not like in Avalon, or they're not in like Manalaking or anything like that. I mean, they're not $1 million beach houses. I wish they were. Eventually, when Rocket Lab goes to $200 billion market cap, but until then,
can we talk about SpaceX? Did you see the headline that they are the largest private company right now?
I've heard anywhere between 600 to 800 billion.
That's insanity.
It's I don't know. I do not know. What I do know is that Starlink is doing well, and I don't know what amount of capital it's generating.
I can't believe I keep forgetting that Starlink is freaking in there.
Mike's keeping tabs on me.
Real quick, do you follow boxing?
I wish I did. It's always a sport that I aspired. There's just so many things, unfortunately. But what's going on with boxing?
No, I mean, I was going through X looking for something, and there's a freaking. Can I play something from X on here if I don't put the sound?
I feel like you can.
I feel like this is so copyrighted that I shouldn't do it. But when Tyson Fury got freaking almost knocked out and then popped up after an 8 count was one of the craziest things I've ever seen in boxing. I mean, Joshua freaking, I don't know. This was crazy.
You're not sharing your screen.
I'm not going to. I'm going to link it on X.
But hey, Steve, I'm gonna cut into this brisket. It's at like 145 perfect temp right now. Eat some of it and listen to you.
Yeah, everybody's saying don't show sports. All right, I'm not going to show it.
But you're the man, and I appreciate you inviting me on. I'm glad I can make it. And is Amit live right now? Oh no, never mind. I was just looking at my 24/7 stream, and it's behind, and I saw like Amit streaming, and I was like, is he really streaming? He just was off.
No, he's taking the night off. I mean, he's back on Sunday night.
Good. But yeah, man, keep me apprised of what is normal time tomorrow. I'm not 100% certain I'll be able to join, but
tomorrow's 9:30. So you should join tomorrow and hang out for the Sunday night investing show.
I try to be like you, Steven. Hey, I came up with another business idea, but I don't know. I'm not going to say it on stream. I need to just knock it out, and then I'll tell you after it's done. But I think it's actually pretty smart, and I need to do it before Christmas. But I'm being lazy. I'm too preoccupied with this Deb 24/7 stream, and I want to get that monetized, and that'll be fun. But this other one, I'm just thinking up stuff right now because I'm lazy and I'm bored, and I'm just like, well, what else can I do? I don't know. You're writing articles. I'm trying to create these small little businesses.
Well,
it's fun.
You could do both.
I'm not smart enough, Steven. Writing is a muscle, and I don't.
You say this, but it's so ridiculous.
It's the truth, Steven.
I mean, you used to write. I don't know why you don't.
I actually got paid by Seeking Out. I got a notification that I got paid, and it's been forever since I've written, as you know.
Well, you must have the residual income coming in because once
those residuals, man, I still print money.
Yeah,
my money's making money. Just kidding.
You're a good kid.
I try to be like you, Steven.
Listen, you should not try to be like me. Please don't try to be like me, but be like yourself. Nobody should try to be like me.
When are you going to buy into Rocket Lab? That's the real question.
Half past the crackle.
It's only what, like a $25 billion market cap, Steven?
I
don't know. I think one day you're like, Matt told me to buy this when it was a
I've already said that you told me to buy it and I didn't. It was a mistake. I already said that. I don't believe that much in the company. I don't believe in the sector. I don't know. I'm obviously wrong.
You're right. I mean, if you don't believe in it, then that's fine. I completely understand your point.
And I'm probably wrong because obviously space is going to be a big thing. I don't know.
I love you guys too. I appreciate all the love in the chat. I don't know why my camera is being weird. I think I have to do a computer restart. It's really strange. Let me show you. As soon as I hit camera.
Matt Money, we miss you on the stream.
See, that's what happens when I hit the camera button. It closes me out. That's why.
Are you using a laptop or a desktop?
Laptop, but I have a webcam. It's not like it's a laptop.
Why don't you unplug it and plug it back in?
Steven, this is why they pay the big bucks. Hold on.
Well, let's see if he can get his camera working. It does not look like he's getting his camera working. All right. Matt, you don't have to mess around with it. It's all right.
Why isn't that working? Oh, wrong camera. Hey, there he is. Steve, I should have listened to you from many minutes ago.
It's not working. Oh, wait. There it is.
Yeah, I was going to say.
See? All you had to do was freaking... Oh, I want to end on this.
I should have taken it out and blew on it like an N64.
I can't believe I didn't ask Amit this. Did you listen to the Compound and Friends yet?
Not all of it, but I listened to about 40 minutes of it, and I thought it was okay.
Did you? So you heard the beginning when Batnick was talking about prediction markings with freaking Vlad, right?
Yeah, and I'm still trying to understand if I'm going to put money into Kalshi or not.
Like, dude, Batnick hit the nail on the freaking head. He hit the nail on the head in the first 2 minutes. Exactly why prediction markets are going to freaking win. Because even though it's the same amount of money as a spread or anything like that, it's inverse, so it just makes more sense.
What do you mean it's inverse?
I wish I could play the clip, but it'll be copyrighted. That you're basically paying 78 cents to make $1. Yes. Or you're paying 60 cents to make $1. instead of you have to bet freaking 140 to make 100.
Yes.
It's just psychologically, it just makes so much more sense to do it that way. That
And you remember they said it very specifically. It's not a bet. It's a
trade.
prediction. It's a prediction, Stephen. It's a prediction.
Yeah. Prediction.
It's not a bet. It's a prediction, and
Yeah.
that is where the fine language is necessary. That it's a prediction and not a bet. And like you stated.
And think about this. Batnick was 100% right. He's like, he gambles a lot on football. And he's like, I would not bet, what was it? 300 to make $100 for the Patriots to beat the Giants. But he's like, I would sure as hell buy 10,000 worth of contracts at 70 cents to make 30 cents and make 40%. It's the same. I remember the exact equation he used, but he's 100% right with the whole psychological thing. The more that I think about it, Robinhood's going to clean up with prediction markets. Clean up.
Yeah. Would you buy Kalshi at $11 billion market cap?
Is it on that site you sent me?
Yes.
They might have.
There's only like a couple $100,000 left of allocated, so they might have actually finished. But
what's the minimum is 50?
Minimum's 50.
I would consider it. I mean, I think.
Would you do that? Hold on, let me ask. Would you do that or Aptronic?
Oh, Kalshi, 100%.
Really, over Aptronic?
Yeah.
Those are the two that are kind of at play right now.
Yeah, Kalshi, only because when I think about how big sports gambling is, and I do think Kalshi and Polymarket are going to be able to take a large portion of that away, in addition to expanding into so many different types of events that you can't bet on through the traditional sites, economics, politics, everything. So I think they're going to do really, really, really well.
Well, Stephen, enjoy the rest of your stream. Hopefully you're on a little bit. If you just give me 5 minutes, I'll send a picture and you can share it with the friends on stream of my brisket.
Of the brisket. I will stay on for 5 minutes, and then I'm going to try to – I got to make dinner. I got to try to write it. I'm not – at this point, there's no way I'm going to write a Cisco article before the Friday night live.
Friday.
Part. But
what is it? Friday night with what is it called? Let me see.
FinTech Fridays with the boys.
Let me open my schedule. Let me see. Yep, FinTech Fridays with Les Boys.
So yeah, I have no idea what I'm making for dinner, everyone. I may have breakfast for dinner. We may make freaking some eggs the way that I like to make them.
Yeah, you guys are live in 100 minutes.
I know. I don't have enough time to do everything I want to do. I don't have enough time.
You're the man. All right, my man. Let me get cutting so I can show a picture with you guys.
All right.
Thanks for having me on, brother.
Thanks, Maddie.
Bye.
Well, look at that. I screwed up. I did not see Matt's text message when he texted me back. And Matt came on for a long time. Good role model to society. Let's see. Look at this. Chels is making salmon. That sounds delicious. Fry eggs and butter. No, that's not how I make eggs. I have a very particular way of making them. And it's pretty simple, but I put a lot of stuff in there. So maybe I'll do that. I don't know. We'll see what I'm going to do. Campbell's soup. Oh, that's funny. That's funny. Well, a lot of things today. Netflix, I'm still shocked. I'm still shocked about it. More shocked that Apple didn't buy them. I'm shocked that Chenier and SoFi did not get in when I see the names that did get in. Let's see. Steve drowns his eggs in milk. I do not drown my eggs in milk. So I start simmering the pan with oil. I throw a bunch of garlic in, and then I start sauteing my peppers and onions and broccoli and potatoes, and then I dump 4 or 5 eggs on top. I gotta look more into Oracle. And by the way, somebody did ask something about where to eat in New York. If you're up and you are near Bryant Park, there's a ton of good restaurants that you have access to. Benjamin's is right there. Hillstone is right there. I don't recommend Bryant Park Grill. I'm not a fan. It's cool for the atmosphere, but like food wise, I think that there's way better places. I think Benjamin's and Hillstone are amazing. You want to start walking around, you got Uncle Jack's down on 9th and 35th. You got Patsy's where Mid and I go on 2nd and 43rd. You got Tudor City Steakhouse is pretty cool. If you can get into Carbone's, I would highly recommend that. If you want pizza, go down to Bleecker Street, go to John's on Bleecker. Do Prince Street Pizza, do Ray's Pizza. Those are ones, I mean, really good, all those. I have not seen Trump's executive order. I'll have to look into it. Yeah, listen, oh man, Maddie. All right, we're gonna share this. So Maddie wanted me to share this with everybody. Where the hell is? Oh, here we go. So this is Matt's brisket. Looks phenomenal, and he cut into it. All right, looks phenomenal. Thank you for sharing, Matt. Yeah, and if you listen, if you heard me on a midstream and I was driving through the city, it reinforces my theme that we are not getting full self-driving regulation anytime soon. Anytime soon. There is no way full self-driving is working in New York City during rush hour. It's just not happening. I'm sorry. Maybe good for out in middle America and out in the suburbs. New York City driving, even not during rush hour, I'm not seeing it. So, oh my God, when the World Cup gets here, Charles, forget it. No good. No good. All right, I'm officially starving now. I'm going to go make dinner. We will be back at 10 o'clock. So you can come back to my channel. It'll be Tanner, Roy, Tevis, and myself. We will be talking about everything fintech, and we'll go from there. Thank you, everybody, for joining. I really appreciate it. It means so much. Thanks, June. Appreciate it. All the help with modding. Really appreciate it. Really thank you, everybody. The community's been amazing. We definitely have, between Amit, Tanner, myself, Matt, and Chris, Tevis, Roy, we really do have the best community on YouTube. Thank you so much. It means everything. Ray, thank you for everything. Melissa, thank you for everything. Really, really appreciate it. You guys got to stop calling it that. Just because freaking Chris is calling it that, we cannot make this a thing. We cannot make this a thing. It sounds so bad. All right. I will see everybody at 10. Gonna go make food, finish my coffee, get re-energized, and start banging out an article on Cisco. The work never stops. And I will start thinking about some type of investment live series. Maybe we'll start it. We'll do the draft on New Year's Eve. New Year's Eve, I think I'm planning on doing a very long stream. Maybe we'll announce it then. I'll let everybody in on the portfolio and what it's going to be, and we'll figure it out. See everybody at 10. Talk to everybody later.